Myself, Dr. Anurag Kumar, Associate Professor, SFC. Today, I will discuss about the next chapter in corporate accounting, issue of share. Issue of share is very important chapter in corporate accounting because it relates to accumulation of capital for the smooth operation of the business or company. Prerequisite for this video lecture is my first video of intro or introductory video of corporate accounting for the better understanding of the issue of shares. Uh, After completing this lecture, I hope that you all have to know about the procedure of issuing the shares, what are the types of shares to be issued by the companies, and what is the accounting treatment in case of issuing the shares. Now, what is share? Share is a unit of ownership in a company or an organization. It is also considered as an asset because in case a company makes a profit, an amount in proportion to share held by you will be provided to you in the form of dividend. Anyone who holds a share is called a shareholder for that specific financial asset or organization. Means a share is a part of ownership, or you can say unit of ownership. While buying the one share, you are the part of that company. You are able to participate in the company. So while buying the share, you become the owner of the part of the owner of the company, and you are liable to get the dividend from the company. So in that concern, shareholding, as I told earlier, when you buy the shares, you become the member of the company because each and every shareholder names is written in the member of register by the company. It should be noted that organization is allowed to offer shares to be purchased by others through the Companies Act 2013 and has to follow the rules predefined under the Act. Generally, the issue of shares is two kinds: common shares and preference shares. So the company have to follow the rules and regulations in issuing the shares as per prescribed by the Companies Act 2013. And companies have a right to issue the shares. As I told earlier, the public company have the right to issue the shares in public, not the private company. Private company can only issue the share certificate, not the shares. And generally the issue of shares by the companies are two types: equity shares and preference shares. You all have studied about lot about in your 12th standard about the company's accounting shares there. So equity share and preference shares. In the equity share case, there is no fixed rate of dividend, but in case of preference shares, it is a fixed rate of dividend. While buying the preference shares, you can know about your percentage rate of dividend. If you buy the 6% preference shares, you have the right to get the dividend at the rate of 6%. If you buy the 8% preference shares, you have the right to get the dividend at the rate of 8%. The company firstly pay to the dividend pay dividend to the preference shareholders as compared to the equity shareholders. So preference shareholders have the preference in getting the dividends. That's why their names are called the preference. So in case of winding up, the company firstly pay the amount to their debts, debenture holders, then preference shareholders, and residual amount is to be distributed according to the number of equity shareholders to all the equity shareholders. So because they are equity shareholders are the owners of the company. They have the voting rights, they have the participative rights. That type of rights are not available in case of preference shares. So these are the two types of shares which are to be issued by the company. Next is what is issue of shares. The meaning of issue of shares is that the share of an enterprise of any financial asset are distributed among the shareholders, whoever wishes to purchase it. These shareholders can be either individuals, corporates who take part in the buying the shares at a specific price. Means anybody, whether as a personal, individual, company can buy the shares according to their choices from the company. For example, there is an example, a company XYZ Limited, total capital is 6 lakhs. It has divided the capital into 6,000 units of share amounting rupees 100 each. Means the company has 6,000 shares of rupees 100 each. You can see that each unit of our share or share of the company cost is 100. Individual or corporate can purchase the share at this price. Means if you want to purchase the share, one share you have to pay 100 rupees, two share 200 rupees. That is the procedure of issue of share. Now what are the steps involved in issuing the shares? Prospectus issue, application, allotment and call money. Generally, the company have to issue the prospectus to know about the company, about their profits, about their structure, about the board of members. To know about the company, the investor required some handbook or prospectus to know about the company before investing in the company. So it is mandatory by the Companies Act to issue the prospectus. And second is, company cannot demand all the money in one time. Company offers to pay the entire amount in, you can say, EMIs. Suppose take the previous example, 100 rupees, there is a 100 rupee each share, and if you want to buy a 5 share, that is 500. So company doesn't demand your whole amount in one time. Company say that you have the facility to pay that 500 in installments. Firstly, the application money, whenever the company issues their shares and share application, firstly the shareholder have to fill that application form and fill the required application money along with the application form to the company. That is called application money. After receiving the application by the company allotted shares to the shareholders in their account, and company demand allotment money. That is called second money. After receiving the allotment money from the shareholder, the company demand the rest of the money in the form of call money. So these are the payment system in the company. So we today we also tell about the ways of collecting share capital. As I told you that in case of company, they give the option to the public to deposit the share capital in installment system in the way of application money, allotment money, share call money. Company directed to their shareholders that they have the option to deposit the money in the installment system. Or so then company first of all, when issue the share in the public, and public have to fill the application form and deposit the some application money along with this application form. That is called the application money. That is called application money. Then after receiving the application money, the company allotted the shares to the shareholders and demand some money on allotment. Then that is called the allotment money. And after the receiving the allotment money, the residual money is called by the company in the form of calls, first call money, and last installment or last residual amount may be called in the second or final call money. Suppose if the share price is rupees 10 rupees, the company um, may call 3 rupees on application, 3 rupees on allotment, 2 rupees on first call, and 2 rupees on second call. That becomes the total is rupees 10. So that is the medium way to call the whole share capital. Now I will tell you about the accounting treatment, accounting journal entries in case of application, allotment and call. So first of all we have to give, that is the format of journal. First of all we have to give some date. I give some imaginary date, suppose 2021, it is called 20th August. First of all we have to do the entry of receiving the application money through along with the application form, then come. So in case of receiving the application money, we do the entry of uh, bank account debit, bank account debit to share application account, that is LF. Suppose we give some imaginary amount, suppose that is 5 lakh, that is again 5. Again after that we have to do the entry of we receive the application money and then we transfer these application money to share capital account, then entries share application account debit to share capital account, that is 5 lakh or 5 lakh. That is it. Suppose after transferring the share application to share capital, the company allotted shares to the shareholders and company demands allotment money to the shareholders. So first of all, whenever the company demands the allotment money, they have to do some due entry on allotment. Suppose what is the entry for allotment money due? Share allotment account debit to share capital account. Suppose that is also 4 lakh, 4 lakh. We have to give narration also, allotment money due, share application transferred to share capital account, application money received. एंट्री यहाँ पे हो गई 23rd August, no 24th August. When the company did the entry or call the allotment money, did the entry of allotment money due and call the allotment money from the shareholders, then company shareholders give the amount to the company and company receive the amount of allotment. So what should be the entry? It should be that like that, bank account debit, bank account debit to share allotment account 4 lakh, 4 lakh allotment money received. So that the entries of application and allotment. In the next slide we will tell about the entry of share call. So share first call account debit to share capital account. That is the due entry. First call money due, then again 24th August bank account debit to share first call account first call money received. First call money, suppose that is 2 lakh, 2 lakh, 2 lakh, 2 lakh, 2 lakh, 2 lakh. That is the entry of first call. Similarly, same way, the entry is totally same, but the name is changed. In place of first call, we write the second call or final call. 25 August, share second and final call account debit to share capital account. Second call money due. Now bank account debit to share second call account receive second call money, मान के चलिए 1 lakh, 1 lakh, 1 lakh and 1 lakh. So that is the journal entry regarding the issue of shares. In the next video we will discuss about the when we issue the share at premium or at discount. What would be the entry in case of premium or discount, and how we face the situation if the company receive the shares in the form of oversubscribed. What would be the entry in case of oversubscription and undersubscriptions or call scenarios? We will discuss in the later videos. That is the legal disclaimer. Already we have taken all the original things here. So thank you, students.